Most traders begin their journey believing the hardest part of trading is understanding the market. They assume the real challenge is learning the patterns, the indicators, the strategies, the news, the technical structures that move price. If they can just understand the market well enough, they believe consistency will naturally follow. But something strange happens once traders spend enough time in the markets. They learn the patterns. They study the strategies. They understand support and resistance, momentum, trend structure, volatility. They read books. They watch charts for thousands of hours. And yet when real money is on the line, they still make decisions they later regret. They exit winning trades too early. They hold losing trades far too long. They take trades that were never part of their plan. They increase their size after a few wins and give everything back after a few losses. At some point, a trader begins to notice a disturbing pattern. The problem is no longer knowledge. The problem is behavior. This is where the real psychological traps of trading begin to reveal themselves. Not the obvious mistakes beginners make, but the quiet internal forces that affect experienced traders as well. These traps are subtle because they do not feel like mistakes when they happen. In the moment, they feel reasonable, logical, even responsible. But over time, they quietly destroy consistency. The first trap begins with something that feels almost intelligent. It begins with the desire for control. Think about how most traders analyze a chart. They draw levels, they mark zones, they measure retracements. They study patterns that appear to repeat themselves across time. None of these tools are inherently wrong. In fact, many professional traders use them. But something deeper is often happening beneath the surface. Most traders are not really searching for probability. They are searching for certainty. Human beings are prediction machines. Our survival as a species depended on our ability to anticipate danger. We learned to recognize patterns in nature. We learned to anticipate movement, threat, opportunity. The brain is constantly trying to reduce uncertainty by building expectations about what will happen next. In normal life, this ability is extremely useful. In trading, it becomes dangerous because the market is not a stable environment. It is the combined outcome of millions of independent decisions made by people across the world, each acting on different information, emotions, and time horizons. The result is a constantly shifting system where certainty simply does not exist, yet the mind continues searching for it. A trader studies a pattern long enough, and eventually something subtle happens. The pattern stops being a possibility and starts feeling like a prediction. The brain begins to experience the setup not as a probability, but as something that should work. This psychological shift is small but powerful. The moment a trader believes the market should behave a certain way, their relationship with risk begins to change. Stops feel less necessary because the outcome feels obvious. Position size quietly increases because confidence feels justified. When price moves against the position, the trader no longer sees new information. Instead, the mind begins defending the original belief. The market must be wrong. The level is still valid. The move is temporary. Preparation has quietly transformed into certainty. And certainty is one of the most dangerous emotions a trader can experience. Professional traders eventually learn something that most beginners resist for years. Preparation and certainty are not the same thing. Preparation means understanding the context, identifying favorable conditions, defining risk, and being ready to act when an opportunity appears. Certainty means believing you know what will happen. One is a professional mindset. The other is an emotional illusion. The traders who survive long-term do not eliminate uncertainty. They stop fighting it. They understand that every trade exists inside an environment they cannot control. Their job is not to predict what will happen. Their job is to respond well to what does happen. Once this shift occurs, trading starts to look very different internally. The trader is no longer trying to prove an idea correct. They are managing exposure to an uncertain environment. The goal is no longer being right. The goal becomes staying stable while uncertainty unfolds. This may sound like a small difference, but psychologically it changes everything. When a trader no longer needs certainty, The market stops feeling like an opponent that must be predicted. It becomes an environment that must be navigated. But even once a trader understands this intellectually, another trap quickly appears. A trap that sits at the center of almost every trading mistake. It emerges the moment money is on the screen, profit begins to appear in the position, and something inside the trader starts to feel uncomfortable. Not excitement, pressure. Open profit triggers a subtle tension inside the nervous system. The mind immediately begins imagining the possibility of losing what has already been gained. The numbers on the screen fluctuate slightly, and each small movement begins to feel meaningful. The trader starts thinking about securing the result. Just close it now, lock it in, protect the gain. The trade is closed and the relief is immediate. The tension disappears. But an hour later, the market continues moving exactly in the direction the trader originally expected. The analysis was correct. The management was not. At first, this experience confuses most traders. They assume the problem is patience. They assume the solution is discipline. They tell themselves they simply need to let their winners run. But the real mechanism behind this behavior is deeper than patience. It begins with the way the human nervous system interprets uncertainty around money. When a trade moves into profit, the brain does not experience the open gain as something secure. Instead, it registers the possibility that the gain could disappear. The nervous system treats that possibility as a threat. This creates a subtle internal tension. The trader begins monitoring every small fluctuation in price. The mind starts calculating what could be lost if the market reverses. Even a small pullback can feel larger than it really is because the brain has already started mentally claiming the profit as something that belongs to you. And once something feels like it belongs to you, losing it feels painful. Closing the trade removes that tension instantly. The brain receives relief, and relief is powerful reinforcement. Over time, the mind learns that closing winners early is a reliable way to eliminate discomfort. But the exact opposite process happens during a losing trade. When price moves against the position, the numbers on the screen begin to represent something the brain does not want to accept. Realized loss triggers the same areas of the brain that respond to physical pain. The nervous system reacts by trying to avoid that outcome. Instead of closing the trade, the mind begins searching for explanations that allow the position to remain open. The move is temporary. The level will hold. The market will come back. This internal narrative is not random. It is the brain attempting to reduce emotional pain by delaying the moment of realization. If the loss is not realized yet, the mind can still imagine a recovery. So the trader waits. Sometimes the position gets larger because adding size creates the possibility of recovering faster if the market turns. From the outside, this behavior appears irrational. But internally, it feels like a solution. The brain is trying to escape discomfort. This is why the same trader who closes winners too early will often hold losing trades far longer than their plan allowed. Both behaviors are driven by the same underlying process. The nervous system is trying to reduce emotional pressure. Over time, this creates a damaging pattern. Small gains are repeatedly locked in early while losses are allowed to expand. The trader may even maintain a respectable win rate and still lose money overall. The problem is not analysis. The problem is emotional regulation under uncertainty. Eventually, experienced traders begin to understand a difficult truth. Consistent trading requires becoming comfortable with two forms of discomfort that the human brain naturally tries to avoid. The first discomfort appears when a trade is winning. The trader must tolerate the tension of watching open profit fluctuate without prematurely securing it. The second discomfort appears when a trade is losing. The trader must accept a small controlled loss without searching for emotional escape. Neither of these responses feels natural. Both require the trader to act against the immediate impulses generated by the nervous system. This is why some of the most intelligent people struggle in trading. Intelligence does not remove the emotional signals produced by risk. It simply gives the brain more sophisticated ways to justify acting on them. And when emotional pressure increases even further, another powerful trap begins to appear. It often arrives after a painful loss. The trade stops out. The numbers on the screen turn red. The account balance drops. For a moment, the trader sits still, processing what just happened. Then something inside begins to tighten. The loss does not only represent money, it begins to touch something deeper: competence, identity, control. The trader starts scanning the charts again, but the intention has subtly changed. They are no longer searching for the best opportunity according to their process. They are searching for relief. The mind begins looking for any pattern that could quickly recover what was just lost. Price movement that would normally be ignored suddenly looks like a setup. Signals that would normally require confirmation now feel urgent. The trade is taken quickly. Sometimes it even works. And that outcome creates a dangerous lesson inside the brain. The emotional reaction has just been rewarded, but most of the time, the trade fails. Now there are two losses instead of one. The internal pressure increases, and the desire to recover becomes even stronger. This is how traders begin entering sequences of emotionally driven trades, where each decision is influenced by the last result, rather than by objective analysis. Accounts rarely collapse in a single catastrophic moment. More often, they erode through a chain of emotionally motivated decisions made under increasing psychological pressure. The trader believes they are fighting the market. In reality, they are fighting their own need to restore emotional balance. After a trader experiences enough of these cycles, another pattern begins to reveal itself. It often appears in a quieter way, without the emotional intensity of revenge trading. In fact, it often feels like careful analysis. A trader develops an idea about the market. Perhaps they believe a particular asset is about to move higher. The reasoning may seem logical. There may be a pattern on the chart, a piece of news, a shift in momentum. Once this idea forms, something subtle begins happening inside the mind. The trader starts gathering evidence. They scroll through charts and notice levels that support the trade idea. They read commentary that agrees with their view. They find analysis that points in the same direction they are already leaning toward. Each piece of confirming information strengthens their confidence. But what the trader usually does not notice is what they are ignoring. Information that contradicts the trade receives far less attention. Opposing arguments are dismissed quickly. Signals that challenge the position are treated as noise or temporary anomalies. This process happens so smoothly that the trader experiences it as objective reasoning. But psychologically, something very different is taking place. The brain is protecting the belief it has already formed. Human beings have a natural tendency to seek information that confirms what they already believe, while unconsciously filtering out information that challenges those beliefs. In everyday life, this bias helps create stable narratives about the world. In trading, it quietly distorts decision-making. The moment a trader becomes attached to a specific market direction, objectivity begins to fade. Once money is committed to the position, the effect becomes even stronger. Now the outcome of the trade is tied not only to financial results, but also to the trader's sense of being correct. Admitting the trade is wrong begins to feel like admitting the analysis was flawed. The mind resists that conclusion. So the trader continues building a story that justifies staying in the position. They zoom out to longer time frames. They reinterpret price action. They search for commentary that still supports the original idea. Meanwhile, the market continues moving in the opposite direction. This is why structured rules play such an important role in professional trading. Rules are not there because traders lack intelligence. They exist because the mind becomes biased the moment risk is involved. A predefined exit level removes the decision from the emotional moment. When price reaches that level, the trade closes regardless of the narrative the mind has constructed. This may feel mechanical, but it creates something extremely valuable: psychological neutrality. By accepting predefined limits, the trader protects themselves from the slow process of rationalizing a losing position. Over time, experienced traders develop another useful habit. Before entering a trade, they deliberately ask a question that most people instinctively avoid. What if this idea is wrong? Instead of searching only for confirmation, they look for the strongest argument against their position. They study what the market would look like if the opposite scenario played out. They examine the structure that could invalidate their thesis. This practice does not eliminate uncertainty. but it restores balance to the decision process. Because if a trader cannot clearly describe how they might be wrong, there is a good chance they are no longer analyzing the market. They are defending a belief. But even traders who learn to manage bias and emotional pressure eventually encounter another trap that feels far more pleasant. It appears during periods of success. A sequence of trades works well. The account grows steadily. Decisions feel smooth and intuitive. The trader begins experiencing a quiet sense of mastery. At first, this confidence is healthy. Confidence built from preparation and experience is an important part of professional decision-making. But gradually, something begins to shift. Position sizes increase slightly because recent performance feels strong. Trades are taken that sit just outside the usual criteria. The trader begins trusting instinct more than process. The internal narrative changes in subtle ways. Things are clicking right now. The market makes sense. I have a good feel for it lately. This feeling can be intoxicating because it creates the impression that skill has suddenly improved. But markets operate inside probabilities. Even a strategy with moderate edge will occasionally produce long sequences of favorable outcomes, simply through statistical variation. When a trader interprets a temporary streak as evidence of elevated ability, risk begins expanding quietly. The next loss arrives carrying more exposure than usual. The emotional impact is larger because the trader had begun expecting continued success. And just like that, the psychological balance that supported the winning period starts to disappear. Professional traders eventually develop a different relationship with winning streaks. Instead of increasing risk when results improve, they become more cautious. They understand that periods of smooth performance can quietly invite overconfidence. For them, consistency is not created by moments of brilliance. It is created by maintaining the same standards during good periods and difficult ones. The same position sizing, the same entry criteria, the same exit discipline. The market does not know that a trader has been performing well recently. Each trade remains an independent event shaped by uncertainty. And the moment a trader begins feeling invincible is often the moment risk begins quietly increasing. After many years in the markets, a trader eventually reaches a realization that can feel both frustrating and strangely liberating. The psychological traps never fully disappear. The urge to control outcomes still appears. The discomfort of watching profit fluctuate still exists. The impulse to recover losses still emerges after a difficult trade. The mind still prefers information that confirms its beliefs. Periods of success can still produce subtle feelings of invincibility. Even experienced traders feel all of these internal signals. The difference is not that the emotions vanish. The difference is that a space begins to form between the feeling and the action. In the early stages of trading, the two are almost inseparable. An emotional signal appears and behavior follows almost immediately. Fear leads to closing a trade. Frustration leads to entering another one. Confidence leads to increasing size. With enough awareness and practice, that automatic chain begins to loosen. The trader notices the emotion before reacting to it. The discomfort of a fluctuating profit is recognized without immediately closing the position. The urge to recover a loss is observed before another trade is placed. The sense of certainty around an idea is questioned before risk is committed. This small gap between impulse and action becomes one of the most valuable psychological assets a trader can develop. Because trading does not reward emotional intensity. It rewards stability in an environment that constantly produces uncertainty. The purpose of structure and routines in trading is not simply organization. They exist to support that stability when emotional pressure begins to rise. Many traders keep detailed records of their trades, not just the entry and exit prices, but also the internal state surrounding each decision. What the trader was feeling before entering the position. What thoughts appeared while the trade was active? What emotional reactions followed the outcome? Over time, patterns begin to appear. Certain emotional states consistently lead to impulsive decisions. Certain market conditions tend to trigger overconfidence or hesitation. Some traders notice that fatigue increases their risk tolerance. Others discover that previous losses make them overly cautious on the next opportunity. Without reflection, these patterns remain invisible. Once they become visible, the trader can begin adjusting the environment around their decisions. Clear position sizing rules are established before the trading session begins. Exit levels are defined in advance when the mind is calm and not under pressure. Breaks are taken after emotionally intense trades so that the nervous system can settle before new risk is introduced. None of these practices eliminate uncertainty, but they create a framework that prevents temporary emotions from dictating behavior. Eventually, the trader reaches a deeper level of acceptance about the nature of this work. Loss is not an interruption of trading. Loss is part of trading. Every strategy that operates inside probability will produce losing trades, sometimes several in a row. Sometimes during periods when the trader feels they did everything correctly. For a long time, many traders resist this reality. They treat each loss as something that must be avoided or quickly recovered. But that attitude creates constant psychological tension. Professional traders begin relating to loss differently. A small controlled loss is not viewed as a mistake. It is viewed as the cost of participating in an uncertain environment. When risk is defined properly, the loss does not threaten the trader's identity or emotional stability. It simply becomes information. This shift may appear simple, but internally, it changes the entire experience of trading. The trader no longer feels compelled to prove the market wrong. They are no longer chasing perfect predictions or trying to avoid every losing outcome. Their focus moves toward maintaining psychological balance across a long sequence of trades. Consistency in trading does not come from eliminating uncertainty. It comes from developing the ability to remain composed while uncertainty unfolds repeatedly. At the beginning of the journey, most traders believe the market is the opponent they must learn to defeat. Over time, they discover that the market is simply a mirror. It reflects impatience through early exits. It reflects denial through oversized losses. It reflects overconfidence through excessive risk. It reflects fear through hesitation and missed opportunities. The numbers in a trading account tell a psychological story. They record every moment where emotion quietly replaced process. The deeper work of trading begins when a person stops searching only for better strategies and begins observing their own internal responses to risk. The patterns become clearer. The reactions become easier to recognize. The gap between impulse and action grows wider. This process never truly ends. Every new phase of experience reveals another layer of behavior to understand and regulate. But slowly, something important begins to change. Decisions become calmer. Losses are handled with less internal turbulence. Winning periods no longer create the same sense of invincibility. Trading starts to feel less like a battle against the market and more like a practice of maintaining psychological balance inside uncertainty. And when that shift begins to stabilize, the trader finally understands something that once sounded paradoxical. Long-term success in the markets does not come from avoiding losses. It comes from learning how to lose without losing control.